Picture this. You're investing in a company that's draining the planet's resources, harming the environment, and treating its workers poorly. Clearly not a pleasant thought. Well, welcome to the world of ESG investing, where you can put your money to work in a way that aligns with your values and contributes to a better future. Today, we're diving into the essentials of ESG investing for beginners. First off, what does ESG even stand for? ESG stands for environmental, social, and governance. It's a way to evaluate companies based on their commitments to sustainable and responsible practices. In other words, ESG investing helps you ensure that your investments are making a positive impact on the world. But why is ESG investing becoming so popular? Simple, it's the perfect blend of doing good and doing well. Ethics and investing are two words you don't often find together. Over the years, corporations have carried out many environmental and social harms in the name of profits. This leaves investors in a dilemma when investing for wealth creation. Thankfully, research shows that companies with strong ESG performance often outperform their less responsible peers in the long run. This is because companies that are proactive in their policies may face lower regulatory and legal risks or the need to make major changes to their operations in the future. Regulations tend to become stricter over time to ensure that corporations who had previously focused exclusively on profitability and disregarding issues from minimum wages to pollution restrictions become more sustainable. So, not only do you get to make a difference, but you could also reap the financial rewards. Let's look at the 3 pillars of ESG investing. 1. Environmental. This covers a company's impact on the environment, including energy usage, waste management, pollution, and greenhouse gas emissions. It also considers their commitment to sustainable practices, such as renewable energy and resource conservation. 2. Social. This aspect looks at how a company treats its employees, customers, and communities. Key factors include labor practices, diversity and inclusion, human rights, and product safety. 3. Governance. Governance examines a company's leadership and decision-making processes. It includes factors like executive compensation, board diversity, shareholder rights, and ethical business practices. ESG investing involves analyzing these 3 pillars and how they fit in with standard financial models. Traditional financial models have long focused, almost exclusively on monetary factors, even at great cost to others. It's important to note that there's no standardized approach to analyzing companies' ESG credentials. However, there are 2 broad strategies that are used: negative and positive screening. Negative screening involves not considering companies or funds based on certain traits. For example, you may look to avoid firms investing in coal mining or gambling. Further, companies with a history of human rights violations or companies that have committed fraud may be discarded. Positive screening, on the other hand, looks to invest in companies that are actively supporting positive initiatives such as the reduction of greenhouse emissions, investing in wind, solar, or other sustainable activities. Further, companies with equal opportunity employment practices and diverse management teams would be highly regarded. Most companies will have an ESG section in their annual reports, which lists regulatory filings, the societal and environmental impacts of their operations, as well as the initiatives they are undertaking. Now, let's talk strategy. How do you actually get started with ESG investing? Here's a step-by-step guide to building your first ESG portfolio. But make sure that you stay to the end, as we'll be discussing some important pitfalls with ESG investing that you shouldn't miss. 1. Define your values. Determine what ESG issues matter most to you. Are you passionate about climate change, social justice, ethical governance? Be clear about your priorities. 2. Do your research. Dive into company reports, news articles, and ESG rating systems to find businesses that align with your values. Look for companies with a proven track record of strong ESG performance. 3. Diversify. Just like any other investment strategy, diversification is key. Build a well-rounded portfolio by investing in companies from different sectors and regions that meet your ESG criteria. 4. Consider ESG-focused funds. If you're not comfortable picking individual stocks, consider ESG-focused mutual funds or ETFs. These funds are managed by professionals who specialize in identifying and investing in companies with strong ESG performance and which ones are doing the bare minimum. 5. Monitor performance. Keep an eye on your investments and their ESG progress. Companies can change, and it's essential to stay informed and make adjustments as needed. 6. Stay engaged. Consider engaging with the companies you invest in through shareholder activism or supporting organizations that promote responsible business practices. Alright, so you've got your first ESG portfolio. Unfortunately, even ethical investing has its shortcomings, and while it's important to put your money into companies that you can truly stand behind, Relying just on the ESG label can leave you paying higher costs while still investing in companies you wish to avoid. There are some important shortcomings that you need to be aware of before you go buying any ESG stocks or funds. ESG investing is not a standardized approach, and you may find that some ESG funds may not align with your values. For example, you may be shocked that some ESG funds can hold fossil fuel companies. ESG factors can be difficult to analyze. There are a lot of details to consider, including a company's operations, their supply chains, their employees, their partners, etc. Beware of greenwashing. Some companies may exaggerate their ESG credentials. Dig deep into their claims and verify their actions. Strict ESG criteria can limit your portfolio's diversification and provide a much smaller pool of stocks to choose from. As ESG funds and high-ranking ESG stocks garner a lot of demand, they can actually be more expensive. Further, ESG funds tend to charge a higher fee than traditional funds, and highly visible ethical companies tend to trade at a higher multiple than their peers. Don't ignore financial performance. ESG investing is about balancing impact and returns. A strong ESG profile doesn't automatically make a company a sound investment. Stay curious and keep learning. ESG investing is a rapidly evolving field. Stay up to date on trends, developments, and best practices to make informed decisions. Remember, ESG investing is about more than just making money. It's about harnessing the power of your investments to drive positive change in the world. So, whether you're a seasoned investor or just starting, now's the time to join the ESG movement and make your investments work for the greater good.